The European Union has introduced a new rule that limits how much cash you can use for a single transaction. This regulation is part of a broader effort to modernize the financial system and ensure that transactions are more secure and traceable. The aim is to make it harder for criminals to launder money. By limiting cash transactions, authorities hope to reduce the amount of illicit money flowing through the economy. This is particularly important in the fight against organized crime and terrorism financing. And to encourage more people to use digital payment methods. Digital payments are not only more convenient but also provide a clear record of transactions, making it easier to track and audit financial activities. The limit is set at €10,000 or the equivalent in your local currency. This means that for any transaction exceeding this amount, you will need to use a bank transfer, credit card, or another traceable method. This means that any payment over this amount must be made using a bank transfer, credit card, or another traceable method. These methods are not only safer but also help in maintaining a transparent financial system. This new law applies to all 27 EU member states. Each country will be responsible for enforcing the rule and ensuring compliance among its citizens and businesses. It covers a wide range of transactions, including buying goods and services, paying for property, and making investments. Whether you're purchasing a new car, investing in real estate, or buying high-value goods, you'll need to adhere to this limit. There are some exceptions to the rule, such as payments to government bodies or for essential services like healthcare. These exceptions are designed to ensure that the rule does not negatively impact essential services and government operations. This new policy is a big change for many people in the EU. It represents a shift towards a more regulated and transparent financial environment, which may take some time for people to get used to. It's important to understand the rules and how they will affect you. Consulting with a financial advisor can help you navigate these changes and ensure that you remain compliant with the new regulations. If you're planning a large purchase, make sure you know how you're going to pay for it. Being aware of the payment methods accepted for high-value transactions can save you from potential legal issues and ensure a smooth transaction process. The EU believes that this new law is a necessary step to combat financial crime. By making it more difficult for criminals to use large amounts of cash, the EU aims to create a safer and more secure financial environment for everyone. They argue that it will make it more difficult for criminals to operate and will help to create a fairer and more transparent financial system. This move is seen as a crucial step towards enhancing financial integrity and protecting the economy from illicit activities. The EU's cash payment limit is primarily aimed at tackling financial crime. Large cash transactions are often associated with illegal activities. These include money laundering, tax evasion, and even terrorism financing. Criminals often use cash because it is difficult to track. When money changes hands multiple times, it becomes almost impossible to trace its origin. Digital transactions, on the other hand, leave a clear trail that can be followed by law enforcement. By limiting cash payments, the EU hopes to make it more difficult for criminals to operate. This will make it harder for them to move money around undetected. The aim is to disrupt criminal networks and make Europe a safer place. This is not just about catching the bad guys, it is also about protecting ordinary citizens. Financial crime costs the EU billions of euros every year. This money could be used to fund essential public services. The new cash limit will have a significant impact on certain businesses, particularly those dealing with high-value transactions. Luxury goods retailers, art dealers, and real estate agents are among those who will feel the effects most acutely. Imagine walking into a high-end boutique to buy a diamond necklace worth €20,000. You can no longer simply pay with a stack of bills. You'll need to use a bank transfer or credit card, potentially incurring fees and delays. The art market, known for its discretion and reliance on cash transactions, will also face challenges. High-value art sales, often conducted through private deals, may become less attractive to buyers seeking anonymity. Real estate transactions, often involving large sums, will also be affected. While mortgages typically cover a portion of the purchase price, down payments and other fees often require substantial cash payments. The new limit could slow down transactions and make it more complex for buyers and sellers. The EU's cash payment limit has implications for everyone living in or visiting the bloc. While everyday purchases remain unaffected, larger transactions require planning and adaptation. For EU residents, the new rule necessitates a shift towards digital payment methods. Credit cards, Debit cards and online banking will become more prevalent for significant transactions. This may require individuals to become more comfortable with technology and online security measures. Tourists and expats using large amounts of cash may find themselves inconvenienced. Exchanging large sums of foreign currency into euros could become more complex. It's crucial for visitors to be aware of the limit and explore alternative payment options before arriving in the EU. The impact on individuals will vary depending on their reliance on cash. Those accustomed to digital payments may find the transition seamless. However, those who prefer cash or lack access to digital financial services may face challenges. Section 5. A global trend. Will other countries follow suit? The EU's move to limit cash payments is part of a broader global trend toward reducing the use of physical money. This shift is driven by the increasing digitization of financial transactions and the convenience of electronic payments. As technology advances, more people are opting for digital wallets and online banking, making cash less essential in daily life. Several countries have already implemented similar measures. These policies are not just limited to Europe, but are seen in various parts of the world, reflecting a global shift in how financial transactions are conducted. France, for example, has a cash payment limit of €1,000 for residents and €3,000 for visitors. This policy aims to curb illegal activities and promote transparency in financial dealings. Italy has a limit of €2,000 for cash transactions. The Italian government believes that reducing cash usage can help combat tax evasion and money laundering, which are significant issues in the country. These countries, like the EU, cite concerns about financial crime and tax evasion as the primary drivers behind these policies. By limiting cash transactions, they aim to create a more secure and transparent financial environment. The EU's decision could influence other countries to follow suit. As a major economic bloc, the EU's policies often set a precedent that other nations consider adopting. As the world becomes increasingly interconnected, international cooperation is essential to combating cross-border crime. Harmonizing financial regulations, including cash payment limits, can help create a unified front against illegal activities. Harmonizing cash payment limits could make it more difficult for criminals to exploit loopholes in different jurisdictions. A unified approach can enhance the effectiveness of these measures and ensure that no country becomes a safe haven for illicit financial activities. However, not all countries are on board with limiting cash. Some nations believe that cash is an essential part of their economy and culture, and imposing limits could have negative repercussions. Some argue that it disproportionately impacts vulnerable populations who rely on cash. Elderly individuals, low-income families, and those without access to digital banking are particularly affected by these restrictions. Others express concerns about government overreach and the erosion of financial privacy. They worry that limiting cash transactions could lead to increased surveillance and control over personal finances, infringing on individual freedoms. Section 6. Big Brother is watching privacy concerns in a cashless world. While the EU's cash payment limit aims to curb financial crime, it also raises concerns about financial privacy. Critics argue that it gives governments and financial institutions unprecedented access to individuals' spending habits. Every digital transaction leaves a digital footprint. This data can be tracked, analyzed, and potentially used for purposes beyond crime prevention. Governments could use this information to monitor citizens' activities, target them with advertising, or even restrict their access to certain goods and services. Furthermore, a cashless society could create barriers for those who value their privacy or lack access to digital financial services. Individuals without bank accounts or reliable internet access could face exclusion from essential transactions. While proponents argue that digital payments offer increased security and transparency, critics worry about the potential for abuse. Striking a balance between combating crime and protecting individual privacy is a complex challenge with far-reaching implications. Section 7. Balancing Act: Convenience versus Control in the Digital Age. The shift towards a cashless society presents a trade-off between convenience and control. Digital payments offer undeniable benefits, including speed, convenience, and reduced risk of theft. Imagine no longer needing to carry bulky wallets or search for ATMs. Digital payments allow for seamless transactions, whether you're shopping online, paying bills, or sending money to friends and family. Furthermore, digital transactions are generally more secure than cash, offering protection against loss or theft. However, this convenience comes at a price. As we rely more on digital systems, we become more vulnerable to data breaches, cyber attacks, and technical glitches. A single system failure could disrupt entire economies and leave individuals unable to access their funds. The debate over a cashless society is ultimately about finding the right balance between innovation and individual rights. It's about harnessing the benefits of technology while safeguarding privacy, security, and financial inclusion for all. Section 8, a cashless future, utopia or dystopia. The EU's cash payment limit is a significant step towards a future where physical money plays a diminished role. This move is part of a broader trend towards digitalization, where transactions are increasingly conducted through electronic means. As we transition to this new era, it's essential to consider the implications for society at large. Whether this future is utopian or dystopian depends on how we navigate the challenges and opportunities it presents. The shift to a cashless society could bring about significant changes in how we interact with money, how businesses operate, and how governments regulate financial systems. On the one hand, a cashless society could be more efficient, transparent, and secure. Digital transactions can be tracked and monitored, reducing the risk of fraud and theft. This transparency can also help in curbing illegal activities such as money laundering and tax evasion. It could reduce crime, increase financial inclusion, and foster innovation in the financial sector. With digital payments, people who previously had no access to banking services can now participate in the economy. This can lead to greater economic growth and development, especially in underserved regions. Imagine a world where transactions are instantaneous, borders are less relevant, and the barriers to economic participation are lowered. In such a world, people can send and receive money across the globe with just a few clicks, making international trade and cooperation more seamless. On the other hand, a cashless society raises concerns about privacy, control, and the potential for exclusion. Without cash, every transaction leaves a digital footprint, which can be tracked and analyzed. This raises significant privacy issues, as individuals' financial activities could be monitored by corporations and governments. It's crucial to establish robust regulations that protect individual rights, ensure data security, and prevent discrimination against those who rely on cash. Elderly people, low-income individuals, and those living in rural areas may find it challenging to adapt to a cashless society. Therefore, policies must be inclusive and considerate of these groups. The future of money is not predetermined. It is shaped by the decisions we make today. As we move towards a cashless society, we must weigh the benefits against the potential drawbacks and strive to create a balanced approach. It's up to us to shape it in a way that benefits everyone. By involving diverse stakeholders in the conversation, we can ensure that the transition to a cashless society is equitable and just. Public input and democratic processes are essential in shaping policies that reflect the needs and values of all citizens. By engaging in open dialogue, addressing legitimate concerns, and embracing innovation responsibly, we can create a future where financial technology empowers individuals and creates a more equitable society. The journey towards a cashless future is complex, but with careful planning and consideration, it can lead to a world where everyone has the opportunity to thrive.